A warning from CoreLogic just rocked Tampa. A 70% chance that home prices here keep falling, putting this city at the top of the nation's crash risk. In barely a year, Tampa's once booming housing market has flipped. Prices down across every major index, momentum reversed, investors cutting losses. How did Florida's pandemic destination become a cautionary tale almost overnight, and just how much further could Tampa fall? A 70% probability. That's the figure CoreLogic assigns to Tampa's risk of ongoing home price declines. A number that stands out not just for its size, but for the authority behind it. CoreLogic, a global leader in real estate analytics, rarely issues warnings this stark. Tampa does not just top Florida's risk charts, it sits among the 5 most vulnerable markets in the entire United States. The company's models, refined over decades and trusted by major lenders and insurers, now classify Tampa as a market facing very high risk of further price drops. At the center of this assessment is Dr. Selma Hepp, CoreLogic's chief economist. She leads the team responsible for developing the probability models that drive these warnings. Using transaction records, mortgage applications, sales trends, and a surge in active listings, her group builds a picture of local market stress with a degree of precision few can match. Dr. Hepp points to a clear pattern: flattening prices, mounting inventory, and a sharp drop in home buying demand. These signals, she says, are not the usual fluctuations. They represent a decisive turn in market sentiment. CoreLogic's risk model goes deeper than headline price drops. It tracks the velocity of sales, the length of time homes sit unsold, and the proportion of listings with price reductions, now approaching 1 in 3 across Tampa. Inventory spikes and mortgage application declines are weighted heavily in the model, pushing Tampa's probability score far above the national norm. The company's methodology, which correctly flagged downturns in Las Vegas and Phoenix before the 2008 crash, is built to detect the early phases of a correction, not just the aftermath. The language CoreLogic uses is telling. Florida markets are continuing to fall out of favor. This is more than a cooling or a pause. For Tampa, the data points to a market in retreat, a city that just 2 years ago was a magnet for buyers and investors from across the country. Now it leads the state in risk, with Winter Haven and West Palm Beach trailing behind. The severity of this warning is not lost on industry insiders. When CoreLogic assigns a 70% probability to further price declines, it's not a speculative headline. It's a data-backed call that reverberates through banks, brokerages, and boardrooms nationwide. Dr. Hepp's public statement is direct. Tampa has a 70% probability of continued price declines, the highest in Florida. The message is clear and the evidence mounting. For anyone watching Tampa's housing market, CoreLogic's warning is not just another forecast. It's a red flag grounded in data, demanding attention before the numbers come in. Tampa's housing downturn is not a matter of opinion. It's written in every major price index. According to the Zillow Home Value Index, home values across the Tampa metro are down 5.6% year over year as of October 2025. This is the sharpest annual drop since the aftermath of the last housing crash in 2011. Local numbers echo the same direction. Hillsborough County's median sales price slipped 0.9% over the past year, with a more recent 0.3% dip recorded in the latest monthly data. The S&P CoreLogic Case-Shiller Index, considered the gold standard for tracking home prices, reports a 1.5% year-over-year decline for Tampa, standing out as one of the few major metros in the U.S. with negative growth, while cities like New York post gains of 7.7%. Month-to-month losses are also picking up speed. Between October 2024 and January 2025, Tampa home values fell 1.6%. That's not just a slow drift lower. It's a clear acceleration, with each new report confirming the momentum. Zillow's broader home value index, which smooths out some of the volatility, still shows a 2.5% drop compared to the previous year. Even in the most resilient pockets like Hillsborough County, the data points to a market under pressure, not a temporary pause. These declines are not isolated blips. They are visible across every major data provider, from local MLS to national analytics firms. The numbers layer on top of one another, painting a picture of a city where price gains have not just slowed, they have reversed. In some submarkets, such as St. Petersburg, the declines are even steeper, reaching 7.6% year over year. The story is the same across Pinellas County and the broader Tampa Bay region. The floor beneath prices is shifting. This is not a matter of how the data is sliced. Whether measured by closed sales, automated valuations, or rolling medians, the direction is unmistakable. The drop is broad and it is accelerating. Experts point to the convergence of these indices as proof that Tampa's housing correction is real and deepening. Each metric, Zillow, Case-Shiller, local MLS, brings a slightly different lens, but all confirm that the market's momentum has swung sharply negative. For buyers and sellers alike, these numbers are more than statistics. They define expectations, shape negotiating power, and set the tone for what comes next. In Tampa, the evidence is mounting from every angle. The downturn is not only here, it is gaining speed. Tampa's transformation from one of the nation's hottest housing markets to a cautionary tale is captured in a single number, 19. That's the number of places Tampa plunged in Zillow's national market heat rankings over the past year, sliding from 10th to 29th. Only Memphis and Las Vegas have seen similar drops. And among large metro areas, San Francisco alone ties Tampa's dramatic fall. For a city that just months ago was a magnet for buyers and investors, the reversal is stark and public. The Zillow Home Value Index, a widely watched metric that weighs price trends, sales velocity, and buyer activity, once put Tampa among the most desirable markets in America. Its top 10 status drew headlines and fueled a sense of unstoppable momentum. Now that momentum has not just slowed, it has reversed. The fall to 29th is more than a statistical quirk. It is a signal that Tampa's boomtown image has faded in the eyes of buyers, sellers, and industry analysts alike. This ranking isn't based solely on prices. Zillow's index factors in buyer demand, days on market, and the pace at which homes are snapped up. When a city drops 19 spots in a single year, it means that across the board, offers, showings, and sales, activity has dried up. Homes that once sparked bidding wars now linger unsold for weeks. Open houses that used to draw crowds now see only a trickle of visitors. The market's energy, so palpable during the pandemic surge, has dissipated. Tampa's ranking collapse is not an isolated data point. It is mirrored by similar declines across Florida, with Jacksonville and Orlando also falling in the national standings. Only Miami has managed to climb, underscoring how Tampa's reversal is part of a broader regional cooling. But the magnitude of Tampa's drop sets it apart. The city's rapid descent from the top 10 to the bottom third of major markets is among the steepest in the country. Industry experts point to this ranking as a barometer of shifting sentiment. When a city falls out of favor so quickly, it rattles confidence among homeowners and investors. The psychological effect is real. Buyers who once feared missing out are now content to wait. Sellers, seeing their city slip down the charts, are forced to reconsider their asking prices. Even national firms tracking market momentum have flagged Tampa's ranking as a warning sign, citing it as evidence that demand has dried up faster than almost anywhere else. The story behind the numbers is one of perceptions changing almost overnight. The same market that saw homes sell in days now faces skepticism and hesitation. The Zillow plunge is not just about where Tampa stands today. It's about how quickly the market's reputation has eroded. For a city that built its pandemic-era boom on national attention and out-of-state demand, the loss of that spotlight carries real consequences. The next chapter will be written not just by price charts, but by what happens as supply continues to build and the pool of eager buyers grows ever smaller. In Tampa Bay, the housing market's most visible symptom isn't just falling prices, it's the sheer volume of homes now sitting unsold. At the heart of the crisis is an inventory glut that has reached levels not seen in nearly a decade. As of mid-2025, Hillsborough County alone lists 5,400 homes for sale. Pinellas County adds another 5,600. Across the metro area, active listings have surged to over 19,000, an inventory peak stretching back 7 to 8 years. Compared to pre-pandemic norms, listings are up 7.3%, a sharp reversal from the days when buyers scrambled for scraps and every open house meant a bidding war. This flood of supply is not accidental. During the pandemic boom, developers raced to break ground on new projects, convinced that Tampa's surge of newcomers and sky-high demand would last. Construction cranes became a permanent fixture on the skyline, from downtown condo towers to sprawling suburban subdivisions. Permitting hit a high in 2022, with area-wide residential approvals up 27% from 2019. Even as demand began to falter in 2023, the pipeline of projects kept moving. Developers had already committed capital, purchased land, and locked in contracts. By the time the market cooled, thousands of new units, condos, apartments, and single-family homes were already under construction. Now the consequences are inescapable. Builders can't halt projects midway without incurring massive losses. Instead, they're forced to finish and list new homes into a market where buyers have all but vanished. The result is a wave of completions hitting just as demand collapses. Urban high-rise condos, once marketed as exclusive opportunities, now sit unsold for months. In Brandon and Westchase, entry-level tract homes wait for buyers who no longer feel urgency. Downtown Tampa alone faces over 2,000 new condo units and nearly 3,000 rental apartments in the 2024 to 2025 pipeline, with absorption rates slowing and incentives multiplying. Behind the scenes, the struggle is even clearer. Developers, wary of harming their brand, rarely discuss the crisis publicly. But private sales memos and broker communications reveal a different reality. $50,000 price reductions on unsold condos, free upgrades, and promises to offset homeowners association fees for a year. Some projects offer 2 or 3 months free rent just to fill new apartments. In the luxury segment, bulk deals and forced sales are surfacing as lenders push for any movement on stagnant inventory. Days on market for new builds now run 30 to 70% longer than for older homes, especially in high-rise towers and large suburban developments. A developer who started a downtown condo tower in 2021 describes the dilemma. "We sold out 40% of units at peak prices by early 2023. The rest have sat for months, even with $50,000 incentives. We can't lower prices much further without breaking loan covenants, but we can't afford to keep them empty. Every month, the carrying costs eat away at our margins." This is the reality for builders across Tampa Bay. Projects committed during the frenzy must now compete not only with each other, but with a wave of existing homes whose owners are increasingly desperate. The supply-side pressure is relentless, forcing developers and homeowners alike to cut prices, sweeten deals, or risk sitting on unsold properties for months. As inventory continues to build, the consequences ripple outward, making it harder for anyone to sell, and setting the stage for the next wave of investor liquidations. Investors once seen as Tampa's market makers are now its most motivated sellers. In neighborhoods dotted with new construction and empty units, the data tells a story of retreat. Nick Gurley, founder of Reventure Consulting, tracks the exodus daily through public records and private databases. His latest findings show hundreds of investor-owned properties listed at steep losses, some as much as 20% below their original purchase price. These are not isolated flips gone wrong. They're deliberate exits by both individual and institutional owners who bought at the height of the boom, ran the numbers, and decided to take the hit. A downtown condo purchased for $500,000 in 2022 now sits unsold at $400,000 after 3 months on the market. The owner, a self-described data-driven investor, has slashed the price repeatedly, hoping to attract a buyer before further losses mount. This kind of haircut, $100,000 wiped out in less than 3 years, has become increasingly common, especially in high-rise towers and new developments where competition is fierce and buyers are scarce. MLS Records and Reventures database confirmed dozens of similar stories across the city, from Channelside to Carrollwood. Institutional players are not immune. National real estate investment trusts and private equity funds, once bullish on Tampa's rapid growth, are now unloading entire portfolios. Earnings calls refer to strategic repositioning and capital redeployment, but the local records show what that really means. Bulk listings at marked-down prices, sometimes with concessions or closing cost coverage just to move the properties. In many cases, these firms are accepting 15 to 25% losses, a level of capitulation that signals a lack of faith in near-term stabilization. The psychology behind these decisions is telling. Unlike homeowners who may wait out a downturn, professional investors respond to risk with speed. When the so-called smart money is willing to lock in a 20% loss, it's a signal that expectations for further declines are baked in. Nick Gurley puts it bluntly. When investors are liquidating at a loss, they're not betting on a rebound. They're betting the pain isn't over. The impact ripples outward. As more investor-owned homes hit the market at discounted prices, they drag down comparable values for owner-occupiers and force other sellers to cut their own asking prices. The average reported declines, 5.6% year-over-year for Tampa Metro, 7.6% in St. Petersburg, understate the reality for those caught in the liquidation wave. In some pockets, especially new condos and suburban developments, price cuts of $80,000 to $120,000 are not unusual. Behind the numbers is a sense of urgency. Many investors cite rising holding costs, including elevated property taxes and looming insurance hikes, as reasons to exit sooner rather than later. Others point to the relentless rise in inventory and the growing time it takes to close a sale. The longer a property sits, the greater the risk of chasing the market down. For Tampa, the investor sell-off is both a symptom and a driver of the broader correction. It's a feedback loop where panic sales accelerate price declines, and falling prices fuel more panic sales. The confidence that once defined Tampa's boom has given way to a scramble for the exits. Insurance premiums in Tampa have become an obstacle few buyers can ignore. As of late 2025, homeowners in the metro area are paying 3 times the national average for coverage. Annual bills of $6,000 to $8,000 are now routine for properties near the coast. Even homes farther inland face premiums that have doubled within 3 years. For many, the cost of insurance alone now exceeds what they pay in property taxes, adding thousands of dollars to the yearly cost of ownership and erasing any sense of affordability, even as home prices fall. The roots of this crisis run deep. Years of mounting legal claims, hurricane risk modeling, and insurer losses across Florida have forced dozens of private companies to withdraw from the state since 2022. Large national carriers have pulled out entirely, leaving a patchwork of smaller firms and the state-run Citizens Property Insurance as the last resort. Policy cancellations have spiked, with thousands of Tampa area homeowners receiving non-renewal notices in the past year. For some, the only option is to accept a bare-bones policy at a premium that rivals a second mortgage. For buyers, this reality is chilling. Lenders require proof of insurance to close, but the shrinking pool of willing insurers means many homes, especially older properties or those in flood zones, are functionally uninsurable at any reasonable cost. Real estate agents report deals collapsing at the last minute, when buyers receive a final quote and realize the monthly payment will be hundreds of dollars higher than expected. In neighborhoods close to the bay or river, listings flagged as uninsurable linger for months, regardless of price cuts. The situation worsened in the aftermath of the 2024 hurricane season, when storms Helene and Milton skirted the region, raising risk perceptions even without a direct hit. Insurers responded by tightening underwriting standards and raising rates across the board. The number of homes listed for sale jumped sharply in affected zip codes, as owners facing policy cancellations or steep renewal hikes opted to sell rather than absorb the costs. Some waterfront sellers, unable to find affordable coverage, left their homes vacant or accepted deep discounts from cash buyers willing to take on the risk. One Tampa homeowner who bought a Gulfront property in 2022 watched her insurance premium jump from $3,400 to over $8,200 within 2 renewal cycles. After her carrier exited the state, she spent weeks searching for replacement coverage, only to be quoted nearly $10,000 for a policy with higher deductibles and storm exclusions. Facing a market where her home's value had dropped and buyers were wary of the insurance burden, she chose to sell at a loss and relocate out of state. Her story is echoed in waterfront communities across the region, where the combination of falling prices and soaring insurance costs is pushing long-time residents to leave. The insurance crisis is more than a line item on a closing statement. It's a structural shock undermining buyer confidence and crushing demand. Even buyers with strong finances hesitate to enter a market where the cost of protection is unpredictable and, for some homes, unavailable. As listings stack up and sellers grapple with the new reality, Tampa's housing market faces a challenge that price cuts alone cannot solve. Buyers in Tampa are no longer rushing to make offers. The market's freeze is visible in every corner of the city, from downtown high-rises to suburban subdivisions. The cause isn't just falling prices, it's the cost of buying itself. Mortgage rates, which hovered below 3% during the pandemic, now sit stubbornly between 6 and 7%. That change alone adds hundreds of dollars to monthly payments, wiping out much of the affordability that once drew newcomers to the Gulf Coast. For many, the math simply doesn't work. Even as home values drop, prices remain 40% higher than before the pandemic, while local wages have barely budged. Factor in soaring insurance premiums, now 3 times the national average, and higher property taxes from inflated assessments, and the total monthly cost of ownership has outpaced what most families can manage. Buyers who might have stretched to compete in 2021 are now stepping back, waiting for a better deal or a sign that costs will ease. Jeff Fahey, a Tampa realtor with 2 decades in the business, sees the impact firsthand. The median sale price in Tampa Bay is roughly $412,000. And it's been around this point for nearly 2 years, he says. But the difference now is buyers are pausing. They're not afraid to walk away from a deal if the numbers don't add up. Fahey describes a market where showings are down, offers are rare, and negotiations favor the buyer, an environment that would have been unthinkable during the frenzy of 2021. The psychology of home buying has changed. Buyers who once feared missing out now fear catching a falling knife. They're waiting for mortgage rates to drop or for sellers to blink first. Days on market have climbed sharply. What used to sell in a weekend now sits for weeks, sometimes months. In some neighborhoods, listings linger for 50 days or more, giving buyers time to compare, negotiate, and even walk away if inspection reports or insurance quotes come back too high. The reversal in migration trends adds another layer of hesitation. During the pandemic, remote workers and out-of-state buyers flooded into Tampa, driving up prices and competition. That tide has turned. Return-to-office mandates have pulled many newcomers back to their original cities, shrinking the pool of motivated buyers. Moving company data confirms a 29% jump in outbound relocations from Tampa in the first half of 2025, with job changes and rising costs topping the list of reasons people are leaving. The result is a market defined by caution. Buyers have leverage, but most aren't in a hurry. They're waiting for clarity on interest rates, insurance costs, and whether the bottom has truly been reached. For now, Tampa's housing market is stuck in a standoff. Buyers holding back, sellers forced to adjust, and the once relentless demand now a memory. While Tampa's housing market endures one of the sharpest reversals in the country, the national picture tells a different story. Across most major U.S. cities, home values have continued to climb. The S&P CoreLogic Case-Shiller Index shows that New York City posted a 7.7% annual gain as of late 2025. In contrast, Tampa stands out as one of the only major metros with outright price declines. Most of the country is still seeing growth, or at worst, a leveling off. Tampa's minus 5.6% drop, as measured by the Zillow Home Value Index, is not just an outlier. It's a warning sign that the forces at work locally are stronger and more disruptive than those shaping the national market. What makes Tampa's downturn so severe is the convergence of multiple risk factors. The pandemic boom brought record migration and a construction surge, but those tailwinds have turned to headwinds. Inventory is at a decade high. Migration has reversed, with census and USPS data showing net arrivals to Hillsborough County down 69% since 2022. Return-to-office mandates have sent many recent transplants back to their home states. Meanwhile, insurance premiums have tripled compared to the national average, and affordability has collapsed even as prices fall. In other regions, one or two of these pressures might be present. In Tampa, they have all arrived at once. For many, the comparison to 2008 is inevitable. Yet this is not a replay of the subprime mortgage crisis. Lending standards have remained tight, and most buyers since 2017 have significant equity. There's no wave of forced foreclosures or systemic banking distress. Instead, the pain comes from a classic supply and demand imbalance. Too many homes chasing too few buyers, with additional pressure from insurance costs and a shrinking pool of newcomers. The correction is sharp, but the underlying causes differ from the last crash. CoreLogic's 70% probability warning is rooted in a model that weighs recent sales, inventory growth, mortgage application declines, and local economic stress. Their approach is more sensitive to short-term shocks than other indices, which may explain why Case-Shiller and Redfin see a milder decline. Still, every major data provider agrees. Tampa's market is correcting, not just cooling. The only real debate is how far it will go and how long it will take to find a floor. Looking ahead, two scenarios are possible. If mortgage rates fall and inventory stabilizes, the market could find its footing, with prices leveling off and buyers regaining confidence. But if demand continues to weaken and new listings outpace sales, further declines are likely. The absence of a foreclosure wave means a total collapse is unlikely, but the process of working through excess supply could drag on for years. Tampa's experience stands as a reminder that even in a strong national market, local shocks can trigger deep and lasting corrections. The city's future depends on how quickly it can restore balance between supply, demand, and the costs of ownership. CoreLogic's 70% probability warning, combined with a 1.5% year-over-year price drop on the S&P Case-Shiller Index, confirms that Tampa is experiencing one of the sharpest housing corrections in the country. Over 11,000 homes are now on the market in Hillsborough and Pinellas counties, the highest inventory levels in up to 8 years. Investors taking 20% losses, surging insurance premiums, and recent hurricanes have added to the downturn. Although lending standards remain tighter than in 2008 and most owners still have equity, the market's overbuilding and migration reversal have left prices disconnected from local incomes. Some questions remain, such as how long the correction will last and when demand will stabilize. Data from CoreLogic, Zillow, and Reventure Consulting all point to continued weakness. Tampa's experience underscores how quickly a boom can turn, and how local risks, like climate and insurance, can shape entire markets. The facts show a market still searching for its bottom.